This is Matthew Cratter from Trader University, and today I want to talk about how Bitcoin gets to $500,000 per coin. The current price is about $57,000 per coin, and the market cap, which is just the product, you multiply the price of Bitcoin times the number of coins that are currently circulating, currently about 18.7 million out of a total of 21 million. You multiply both of those and you get a market cap of about 1 trillion for Bitcoin. And so if Bitcoin is going to go to $500,000, considering the current amount of coins, obviously there'll be a few more coins, but just to make the math really easy, that's a market cap for all of Bitcoin of about 9.35 trillion for all of the circulating coins. And so what a lot of people are always asking me is, well, where is that extra 8.35 trillion going to come from? Now, the first thing I always answer is that's not a lot of money when you think of the size of global asset markets. Global stock market capitalization, roughly 95 trillion, call it 100 trillion. Global real estate market, 280 trillion. And then finally, global fixed income bond market, 119 trillion. And the interesting thing about the fixed income market, of course, is that a lot of this debt is now negative yielding. And so you actually even lose money on a nominal basis. Holding it, 18 trillion of that is currently having a negative yield. But it's actually simpler than this. We don't even need all of this money to flow into Bitcoin for it to achieve a very high market cap of 9 or 10 trillion, which is roughly the order of magnitude of the entire gold market. But before I turn to that, I would encourage you to just hit that subscribe and like button if you're finding this video helpful so far, and maybe share it with a few friends. I'll show you where I got my statistics here. 95 trillion global stock market, 210 trillion real estate market, 119 trillion bond market, and then 18 trillion negative yielding. But I want to use a thought experiment here to show you how Bitcoin can get to much higher prices without a commensurate amount of money flowing into it. So let's create our own cryptocurrency that's a very simplified, closed system. This cryptocurrency will have 10 coins, and let's say they're currently trading at $1,000 a piece. That gives it a $10,000 market cap for the whole cryptocurrency. Just trying to make the numbers really round and easy here. So just looking at this in a naive way, you may think that to get to a $100,000 market cap, in other words, a 10x market cap, which is roughly what we're looking for Bitcoin to do from here to get to $500,000, it needs to go up a little bit less than 10x. In this idealized case, does an additional $90,000 need to flow into the coin? This is, of course, a lot of money, especially with reference to the existing market cap. That would mean 9 times the existing market cap has to flow into it. But the answer is actually no, and this is a little bit counterintuitive to how markets work. Let's set up another idealized scenario within this. Let's say that out of those 10 total coins, again, we have 10 coins that are each worth about $1,000 as determined by the market. Let's say that we have 9 hodlers who are long-term investors in this coin, and each of those 9 people or 9 investors own a coin apiece. So 9 of these coins are locked up for the long term by hodlers who really believe in it. And then we can assume that remaining coin stays very liquid and gets traded back and forth between a lot of newcomers and then people who exit, etc. So it kind of bounces back and forth between new buyers and sellers and gets traded at various prices. All we need to achieve a $100,000 market cap for the entire cryptocurrency is for that one coin to trade at $10,000. If that trades at $10,000, then all of a sudden, all the coins together are worth $100,000. Now, obviously, higher prices can bring out sellers. Maybe once it reaches 10,000, one of these hodlers will want to sell. And of course, sellers create selling pressure, buyers create buying pressure. But I just wanted to show you that in this idealized example, and it's very simplified, maybe even in Bitcoin, this seems quite high that this many people would be hodlers. But this just goes to show how only $10,000 flowing into this cryptocurrency gets you that $90,000 boost. It takes you from $1,000 per coin to $10,000 per coin. Now, we see something similar happening with Bitcoin. If we take a look at what are called HODL Waves, this shows the age distribution of various holdings of Bitcoin based on how long people have been holding them. So this purple area up here is it's roughly 10% of the total amount of Bitcoin that are out floating around, or at least the UTXO set. 10% have been held for 10 years or more. 7% have been held for 7 to 10 years, etc. And what you want to see is you want to see these HODL waves going down and to the right. This shows that more and more people are becoming hodlers. And as time passes, these various cohorts age and they move from the green to the blue to the purple, etc., depending how long they hold them. So we do see this hodling behavior. And whereas for a lot of the sort of degenerate altcoins, there's this trading mentality, the real core Bitcoiner ethos is to buy and hold and to hodl. And this is really where the term originally comes from hold on for dear life, or a misspelling of hold, etc. But this is part of Bitcoin culture, and it's a very important part of it, especially given the fact that there is such a scarce supply of Bitcoin. Only 21 million will ever exist, and many of those have been lost, so the true float and the true number of coins is much, much lower. So as such, we have a situation here that's very similar to what we were talking about, where we do have a lot of Bitcoiners like myself who will literally not sell at any price. I will never sell my Bitcoin. I may borrow against it, and you can watch my video about that. So you can still have access to the money, but I'll never sell my Bitcoin. And as time passes, more and more people adopt this mentality, especially if you think like I do, that Bitcoin is not just going to 500,000, but it's going to 1 million, and then 5 million, and then 10 million and above per coin, not total market cap. And so you have this combination of the scarcity combined with the hodler mentality, which leads to dynamics that are very similar to what we were talking about in our idealized situation. Now, the next question, of course, is what happens to the new Bitcoin that is mined. Obviously, when new Bitcoin is mined in each block, there needs to be a buyer if the Bitcoin miner is selling that Bitcoin. But what we've been seeing lately, especially for the last 2 months, is that Bitcoin miners are increasingly choosing to hold on to their freshly mined Bitcoin, and they're choosing to fund their operations in different ways. They used to still have to sell their Bitcoin in order to buy electricity and buy new ASICs and mining equipment. But now what we're finding is that Bitcoin miners are actually becoming hodlers, and this is a very surprising development, especially even to me. We can see here that the green bars here show that the miner net position is positive and that Bitcoin miners have been hodling. That being said, of course, Bitcoin miners can change their mind. They can start selling their Bitcoin. In that case, you would need new funds to flow into Bitcoin. I believe it's 900 new Bitcoin per day, if I've done the math right, 6.25 new Bitcoin per block. And so you would need that amount of new money coming into Bitcoin to maintain the price. That being such, the more Bitcoin goes up and the more it shows this positive price momentum, we would expect that miners will continue to hodl. Now let's talk a little bit more about the money that's coming into Bitcoin. We've already established that we don't need all $8 trillion to come into Bitcoin. That being said, the amount of money coming into Bitcoin is quite large. We're going to see another wave of retail buyers. We just learned yesterday that hundreds of U.S. banks this year will now be able to offer Bitcoin to their customers. If they're like my bank, what they see is they see money coming in, and then they see the money going out to Coinbase or Gemini or Kraken and being spent on Bitcoin. They can see that in my checking account as it's funding these various Bitcoin accounts and being used to buy more Bitcoin. The banks have finally woken up to this and can see that this is a business that they should get in on. And so we can expect another wave of retail buying once it becomes very easy to buy Bitcoin through your traditional banking service rather than having to open up an account with something like Coinbase. In addition, we'll continue to see corporate flows, corporations that are choosing to store their cash and hedge their purchasing power on their balance sheet by acquiring Bitcoin. The two prominent examples obviously are Tesla and MicroStrategy that each own billions of dollars of Bitcoin. But then we have a lot of smaller companies. Mercado Libre is actually a quite large international company based out of Argentina, an e-commerce company. And we just learned that they, in the last quarter, bought $7.8 million worth of Bitcoin and added it to their balance sheet. This is obviously not a lot of money, especially for a large corporation, but it does show that companies, even in e-commerce and in various parts of the world, are beginning to choose to use Bitcoin as a treasury asset. And to the extent they become hodlers as well, we get really an increase in these hodler waves, and we get the sort of dynamics we talked about, where 9 out of 10 holders are long-term hodlers. Finally, very interesting to see the S&P Dow Jones, S&P Global company just came up with their own Bitcoin index. It's a little weird how it looks. They're not using the price of Bitcoin, but they're rather using an index that measures the appreciation of Bitcoin. Obviously, that appreciation has been parabolic, and it's gone up, according to this, 163% over the last 5 years, 200% over the last 200% per year over the last 11 years. But what's important is that this is yet another index that people can try to match. It's obviously not the most interesting index because it's just Bitcoin, but it does show that institutional investors are taking this seriously, and now there is an index, an official S&P index that tracks Bitcoin. So they're obviously trying to get in on the action as well. These are the sort of dynamics: corporate buyers, individual hodlers, other institutional buyers. We've talked all about the hedge funds buying Bitcoin. And then, of course, there is the game theory of larger players, even central banks. If the rumor came out that a central bank had been buying Bitcoin, maybe a smaller country's central bank, these are the sorts of rumors that could drive huge Bitcoin buying by other central banks who, even though it's a rumor, let's say it's not true, but other central banks think that this one central bank has been buying Bitcoin, it leads to sort of an arms race where everyone has to jump into Bitcoin to get ahead of it, to get some before their competitors and to get some at a lower price than their competitors. And so this would be a great example of how rumor about a central bank buying Bitcoin could actually lead real central banks to buy real Bitcoin, and they are the ultimate hodlers of Bitcoin, possibly in terms of sort of the highest up institutional investors that could flow into Bitcoin. And this really is a Trojan horse as well for the financial system. Once you have central banks hodling Bitcoin, Bitcoin is really here to stay, and it does hurt the power of central banks, which is a great thing. Finally, I can hear the question possibly coming up, well, don't the same principles apply to Dogecoin? Shouldn't I just hodl Dogecoin and get everyone online to do that? Well, the problem with Doge, of course, is that it has infinite supply, it's not scarce, and it's not a good hedge against Fed money printing. It's probably will end up being more scarce than US dollars, but that's really hardly the comparison. Dogecoin doesn't have the same network effects, it doesn't have the same large market cap or liquidity, it doesn't have the S&P 500 creating an index around it. It doesn't have Mercado Libre buying it. It doesn't have. It's not going to be custodied by hundreds of U.S. banks. It just doesn't have the same market cap that Bitcoin has. Bitcoin has the scarcity. It has the credible monetary policy, where the monetary policy hasn't changed over the last 11 years, unlike something like Ethereum, where they change the monetary policy and the issuance rate every couple of years. Bitcoin has the greatest global brand recognition. It's the fastest growing asset to ever hit $1 trillion. It's got very deep liquidity, which is what institutional investors want to see. And it has that first mover advantage of being the first thing that was ever considered to be digital gold, to be a store of value that hedges against inflation and central bank money printing. So it has all these advantages, and there's no reason to think that any other coin can come out of nowhere and flip these advantages, simply because if you're a large institutional investor, you are going to go to the most liquid, deepest, largest market cap market to achieve what you need to do, which in this case is to store wealth, Bitcoin as a store of value. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.